Hello and welcome to this first episode of my brand new weekly series, Renegade Investor Report, with me, Graham Rowan, aka the Renegade Investor. Great to have you along. So, who is Renegade Investor Report for? Well, it's for established investors and business owners who are trying to build and preserve family wealth. And believe me, I'm halfway through my seventh decade, in fact, now, and I've not known a decade like this one. Even before the what happened, it was already looking like a time of incredible opportunities and also unprecedented threats. So it's a time when I think anyone who's in the process of building and preserving, perhaps transferring wealth, needs really good information more than ever before. And I hope to earn the right to become one of your sources of information. And also, if you're a younger investor wanting to try and avoid the mistakes that your parents have made, there are an awful lot of baby boomers who are heading for a dodgy old age because they just haven't put enough away in their pensions or in their property portfolio or whatever it is that's going to drive them through the longer lives that we're all thankfully living these days. But also, it's not just about money. I really want to talk about something very close to my heart, which is freedom and liberty. And the last 18 months have been a truly awful time for freedom and liberty. In fact, one of the casualties of the way we're living today has been freedom of speech, such that there are certain things I can't even mention by name on this very platform for fear of being cancelled. So some of my American chums who are involved in a similar space to this have used the code word bananas, or well, in their case, bananas, for anything to do with what's going on at the moment. So if you hear me talk about the banana virus or banana passports or anything like that, you'll know what I mean. Really, I think if you're concerned about the rising power of governments, the incredible restrictions on our freedom, the cancel culture, potential rising taxes, then I think you'll be a kind of soulmate for the kind of thinking that I have. And for me, certainly, if I look over the last 18 months, I always felt this was a three-dimensional issue. There's a health aspect, there's a economic impact aspect to it, and there's a freedom of citizens aspect. And whilst I don't in any way try to belittle or gloss over the human tragedy of what's happened for the families that have been affected, I do believe that the big loser in all this has been our freedom and our liberty. In the same way as the quantitative easing genie came out the bottle in 2008 and has never gone back in, I think the restrictions on our freedom that have come out of the bottle now, frankly, governments can't believe what they've got away with. They're going to do it again and again and again. And those of us who thought we lived in freedom-loving Western democracies, it's going to be much closer to the kind of totalitarian government you see in China and places like that. So there's a lot going on to be concerned about, but equally there's some amazing opportunities out there. I don't want this to be, this is not going to be a negative kind of show. I'm a very much a glass half full kind of person, and there's huge opportunity out there and there are huge risks out there. We have to be on top of all of it if we're going to live the kind of life we want to live, if we're going to leave the legacy to the world that we want to leave, and if we're going to leave things to our children and transfer things and give our children a decent life, because they're going to inherit the outcome of all this, for which broadly we are responsible. So I think there's a bit of a debt to be paid there too. So the Renegade Investor Report is brought to you by two sponsors. One is the Beaufort Society, which is a private members club for high net worth investors. If you qualify under the FCA rules as a sophisticated or high net worth investor, then you are able to join the Beaufort Society. You just have to fill in a self-certification form and a brief membership application. And they have a really interesting array of investments waiting for you if you're looking for something to add to your portfolio, to diversify into what used to be called alternatives, but I think are really starting to become a bit of an asset class in their own right. So beaufortsociety.com is the place to go to learn more about them. And also we're supported by Crypto for Grown-ups. This is a new program I've launched with the crypto sector expert Dee Ludlow, and we're basically helping people over 40 to understand this whole digital sector. It's an area where most of the involvement, most of the ownership is happening with people under the age of 30. The most recent statistics I saw said that only 12% of people over 45 have had any kind of investment in the crypto space, and only 4% of people over 55. So I'm in that 4%, and it's a very exciting new area. It's a challenging new area. It's the first new asset class since the 1600s. So it's a very kind of Marmite space at the moment. You're getting some early adopters going in, including big corporations, hedge funds, starting to get some other financial institutions on board. And of course, you've got all the naysayers saying it's all going to go to zero and everything else. But hey, have you looked at the mainstream financial system recently? It ain't exactly in the rudest of health. So having some involvement in an alternative financial system strikes me as fairly sensible and smart. So if you want to learn more about that, just go to cryptoforgrownups.co.uk, and there's a video you can watch that's all about that program. If you've not seen me before, I'm a speaker, an author, television presenter on the subject of wealth, primarily wealth creation, wealth preservation, and also business. I tend to resonate with business owners, with property investors, and with people who are just looking for an edge, basically, in how to get on in the world. Some of the series I've done on Sky TV are Finding Financial Freedom, Make Your Money Work, and more recently, Money and Me. And my most recent book is a transcript of interviews with guests. It's kind of like This Is Your Life in a financial sense. So it was successful people talking about their life story, how did they become successful, what lessons would they pass on to other people, and that all got captured in the series and in my book. And one of the great things about doing things like this are the people you meet. So on the left there, that's the biotech billionaire Jim Mellon, who I interviewed for one of those series. In the middle, we did a special documentary around my speaking at the World Wealth Creation Conference in Singapore. I got to meet up there with Jim Rogers, the legendary investor and trader. Great to see him there. I've also done speaking at places like the one with all the flags. There's the UN in New York. The other one's Harvard Business School. So I don't claim to be any kind of guru. I don't claim to have all the answers. What I do try and do is take some of the things that are happening in the real world, which are often quite complex, quite jargon-filled, quite opaque, and I try and turn them into language that I understand and hopefully that you understand, that can help you to make your kind of decisions on how you plan to create wealth, protect wealth, and ultimately transfer wealth to the next generation. So that's me, and I hope you get some value from this Renegade Investor Report. So in this first episode, what I want to try and go through is an enormous debate that's going on at the moment about inflation. The central banks keep trying to tell us it's transient, it's just the inevitable outcome of the banana situation, and it'll all just go back to normal very soon. There are others saying, you've got to be kidding. After all this QE, after all this money printing, inflation, even hyperinflation, must be inevitable. So what I want to do in this session is go through some charts with you, showing some which are definitely in favor of the inflation argument and some which actually suggest the opposite. Maybe we're actually heading for deflation. And then I'll try and draw it to some kind of conclusion as to what that means for us and what we can do about it. So let's get started on that, because in some ways, I think the response to the banana situation, it makes you wonder what these governments are up to. I mean, I started looking for my first foreign citizenships when it looked like Jeremy Corbyn might become Prime Minister of the UK. And, he's a great fan of Venezuela. And obviously he was going to set us down that road. Then little did I realize that a supposedly conservative government under Bojo would actually spend money at a level that would have made Jeremy Corbyn blush. They are peeing money away on anything and everything on a scale never seen before in the UK. So it's clear that I think, and you look at Biden in America with his plans. The point being now, I think, that there is no political party in power, there is no government, there's no mainstream group that regards financial discipline or fiscal fortitude as important anymore. It's just throw money at the problem. If you want to fund your election promises, if you want to get the people on your side, if you want to avoid any kind of trouble, just throw funny money at the problem, just like they did in Venezuela. And what could possibly go wrong? Of course, this is all part of what's now referred to as modern monetary theory, or the magic money tree. And one of its main proponents is Stephanie Kelton, who's now an advisor to the Biden government. And if you want to see just what kind of cloud cuckoo land these people are living in, here's a quote from the great Stephanie herself. "To fix our broken thinking, we need to overcome more than just an aversion to big numbers with the word debt attached. Perhaps we should start by giving it another name. Okay, let's talk about financial goodness, financial well-being. How much financial well-being can we create this year, Boris? Ah, lovely. It must be nice to live in that world." You talk a lot of sense, Stephanie. I'm starting to really like you. Well, let's look at some statistics. Now, I've helpfully added a little arrow on the left-hand side. If it's red, that means I think these are inflationary statistics. If it's blue and pointing downwards, it means I think they are potentially deflationary statistics. So let's start with the retail price index. Now, if you've followed my material for any length of time, you'll know how skeptical I am about government inflation figures. They are manipulated within an inch of their lives. If something starts going up too much, it gets taken out the basket as being inconvenient. So let's put something that's a bit lower priced in there. If your new car has some added features, or your new phone has 3 cameras instead of 2, then somehow that's regarded as a price decrease because you get more for the same price. So, accepting all those caveats about manipulation, it's clear that from April of this year, something happened. And this is obviously, to some extent, post-banana syndrome. But it's interesting here that the very latest figures show a slight reduction. It's certainly increasing at a less fast rate. But by UK standards, 3.8, 3.94% is the longest and highest it's been for a long, long time. So certainly, I certainly have seen, have you seen prices in the shops going up? We were in France recently for the first time in a year. And I would say on average, the prices we were paying for everything from just like a salad lunch in a cafe or something were 20% higher. 20% higher in 1 year than the year before. And of course, supply chains have been messed up. So often you're finding that there's an increase in demand as we come out of lockdown. People have saved all this money in lockdown, so they've got money to spend. But the supply has been screwed by all the things that have been going on with factory closures. There have been fires, there have been floods, there have been shortages of chips that have affected cars. So second-hand car prices started going up enormously because you couldn't get a new one. So the statistics have been skewed by all these things going on in the post-banana world. But there's no doubt about it. At the moment, this year, prices in the high street have definitely been on an upward trend, and we can't escape or deny that. Producer prices, this in a sense is even more significant. This is factories gate prices. So their inputs costs have gone up enormously. There's a shortage of 100,000 lorry drivers in the UK now. They can't even get the stuff out to you once it's been made. If they've got the stuff in to make it, they can't get the deliveries of the raw materials. The raw materials are stuck with all the kind of post-Brexit customs controls. So there's all these kind of factors that are contributing to rising prices. And of course, what we then have to look at is to what extent will these producers absorb these prices themselves and take a narrower margin versus passing them on to the consumer. And my feeling is, if you look at that, from late last year, 107, 108, up to 113, how much longer are they going to keep absorbing that? They may have done it for the first half of the year. I'd be very surprised if they keep doing that in the second half of this year into next year. So that feels to me like that chart is telling me there are more consumer price rises on the way. Because one of the kind of conventional wisdom thinking tenets is that all of this money printing, all of this QE has gone into assets, so that asset prices have gone up. But because wages have tended not to, consumer prices haven't gone up. But we're starting to see a change in that now. And of course, the whole labor shortage, wage thing, labor force participation rates are down. People have got used to being at home with their furloughs and their stimmy checks and whatever. They don't want to go back to work. It's a sad indictment of the human condition and the sense of entitlement in the 21st century. But hey, we are where we are. This seems to be the way people want to live. And of course, house prices. Well, we have a government that is obsessed with the property market, obsessed with keeping the prices rising, always coming up with new schemes with help to buy, with lifetime ISAs, with 95% government-backed mortgages. We have the lowest ever interest rates in all of history. So what a surprise, house prices are going up. And of course, the biggest joke of all was the stamp duty holiday, where all of these people were paying 50 or 100,000 pounds more in a frantic move to buy properties so they could save 15,000 on stamp duty. Really smart thinking, wasn't it? So lots of people have been doing that. Are we going to see that continue? I don't know. It's hard to say, but at the moment, certainly, I think we just saw the first month in August where house prices came down versus all the rises we'd seen, the huge rises. And even when you see these national figures, don't forget that's an average. Although the average might have been 8%, 9%, there are some places that went up 30%. The places that were deemed most desirable for people wanting to escape the banana situation, if they wanted land around themselves, they didn't have to do a commute anymore, they were paying 15, 20, 25% more for those desirable residences in the country, whilst actually in the towns, some of the apartments were coming down in value, because people wanted to move out of the city. So, the property market is not a single entity. It's hundreds and hundreds. You know that. You're mainly all property investors anyway. So, beware of these averages. What they hide is some enormous hikes in the most desired areas and a flat to declining market in the less desirable areas. But overall, absolutely no doubt, housing is contributing to inflation. GDP, this is so distorted by the events of the banana situation. Sooner or later, I'm going to be referring to Britain as a banana republic, clearly. Two things strike me about this chart. I mean, we already knew that, I think it was the worst for 400 years or something last year during the first lockdown. Clearly, any kind of return to normality compared to that figure in July 2020, it just has to reverse, and it's more or less done that. So it's, instead of 22% down, it's 22% up. What scares me more on this chart is the left-hand side, the pre-banana stage. And look at that anemic level of growth for Great Britain, 1.2, 1.4%. I mean, that's pathetic. That's what we should be worried about. That's why we need some growth engines for our economy, and not just through government money printing. We need to be encouraging entrepreneurs and business in a way that's going to generate serious, proper productivity. And I think for me, one of the things that underlies this is that governments and companies have become used to the cheap foreign labor option rather than investing in new plant and machinery that would genuinely increase productivity. And I hope, although there's no early signs of this, Rishi announced this super deduction for new investments. I hope that that is a trigger, and I hope the labor shortages we're seeing now are a trigger for new investment in new technology. One of my neighbors is a consultant in the hotel industry, and she was saying that they are so short of cleaners and chambermaids and so on. Well, the answer is in Japan. They use robots for that. That's got to be the way forward. Instead of trying to find cheap labor to keep your room rates down, use a robot. They'll probably do the job better. They don't take any time off sick. They don't take holidays. Get the robots in there. So, let's hope we see some real investment in real technology that's going to create real GDP growth, and not the artificial kind that's just frankly based on government stimulus, which ultimately you and I will be paying for. Total public sector spending. I talked about Boris making Jeremy blush. Look at that rise. After all those years of some disciplined reduction in public spending, I know there was a lot of opposition to, the fact that services were being managed more tightly. The word austerity was used. Well, austerity is relative. Speak to somebody who grew up in the 1930s about austerity, and I think the situation in the 2010s was somewhat better than that. But look at that 2020 figure. It's just a sick joke as to how much money is being spent. And once this genie comes out of the bottle, I think it'll be quite hard to put back in. People get so dependent so quickly. You look at how central banks have painted themselves into a corner. I think governments are now doing the same thing. This is a particularly scary figure. This is the overall public sector net debt to GDP. So in other words, we are now owing 100% of our GDP. And history tells us that once countries get to that level, A, they're an economic basket case in the making. B, this debt can never, ever be honestly repaid. So, the clue we have to take from this is there's no intention of repaying that. They're going to use another means, which I'll come on to in a moment. So again, look at the scale of that from one year to the next. Okay, you could argue if the banana situation is a once in a century occurrence. Let's hope so, although plenty of scientists seem to think there could be another one in 22 or 23 to look forward to, but let's assume it was a one-off occurrence. This is a bit like a war debt. This is something that your children will be paying until they're well into middle age, if not retirement age, because these amounts simply can't be paid off overnight through some minor change in taxation. But then we look at things going the other way. Look at the yield on government bonds. That is coming down. Now, normally, think about a government bond or a US Treasury or gilt in the case of the UK. The idea here is that you are buying a long-term income stream. You're buying the coupon, the interest payment. So if you thought that there was going to be a time of inflation, then you would want to get a bigger interest rate on that coupon to justify the investment, or you'd be willing to pay less and less and less for something that was stuck at a lower rate of return than you thought inflation was going to become. So what we should expect in the bond markets, if they think inflation is coming, then bond prices should be coming down. And of course, because they pay a fixed yield, the more the price comes down, the more the yield goes up. Yeah, so bond yields move in reverse to the price. So when you hear them say on the news that bond yields have risen, that's usually bad news because it means bond prices have crashed. But they haven't. Look at this chart. At first, the beginning of this year, they thought, are we heading for some inflation? And they crept upwards. But now, since the spring and across the summer, they've been moving downwards. So the bond market, often referred to by people who are smarter than me as being where you find real truth, the bond market is saying, no, we're not heading for inflation. And you'd see similar charts in American treasuries. They peaked up to, I think, about 1.7% earlier this year, and they're back down to, I think it's 1.2, 1.3% now. We're even less generous over here. If you give your money to Boris Johnson for 10 years, he will pay you 0.57% interest. Now, we already said that even the massively manipulated CPI figure is 3.8%. So you're making a guaranteed 3.2% a year loss if you buy these 10-year bonds. So, people talk about, these things being a kind of a safe haven or a store of value or something. Well, hey, that doesn't look too safe to me. And that's only just above what you can get in the overnight rates from the Federal Reserve. So 0.57, definitely suggesting there is not long-term inflation on the way in the eyes of the people and the institutions behind the bond market. And in fact, if you look at the bond market over the last 20 years of this century, that's the direction of travel. It's been actually a remarkably safe bet to invest in, because as interest rates have come down, bond prices have gone up. Fortunes have been made from people simply investing in bonds, waiting for the rates to go down, the yields to go down, the prices going up. It's just been a one-way street for actually, I think, longer than 20 years, more like 40 years. I mean, believe it or not, there was a time when government bonds were paying 12, 14, 15%, and at least were above inflation as well. Well, that has not been the case for some time now. So clearly for years now, for decades now, the bond markets have been a deflationary force. But of course, the last certainly 12 or 13 years have been the bond markets have been the primary go-to target for central banks buying treasuries. This is their way of doing QE. This is how they do it. The asset purchase programs you hear about from the Bank of England, from the Federal Reserve, from the European Central Bank. These are the kind of things they buy. So you've got all this liquidity coming into these markets. And when you've got more buyers than there are things to buy, guess what happens? The price goes up. And in the case of a bond, therefore, the yield goes down. So this has been almost institutionalized now. And of course, the victims of all this are those that are trying to live off fixed income investments. So it's been a great trade to watch the prices go up. It's been a lousy investment if you're looking for passive income, because the yields just go down and down and down. Crude oil, you might remember the start of the banana situation, crude prices going negative. That was, I think, to do with the fact that it wasn't even worth the cost of storage at one point. You could have bought your oil for minus $40 a barrel. It then went on an absolute tear as people realized the world was not ending and we were still going to be using our cars and our trucks and our buses and our airplanes. And so oil went on a tear back up into the mid-70s. And was definitely looking quite inflationary. It's come off that high since then. So across the summer, oil has been in a bit of a range and has been coming down a bit as well. So I've kind of put a slightly down arrow here. I think it looks like at the moment, commodities are not necessarily going to keep on driving prices upwards. Copper's been another one that went sky high and has tailed off a little bit, but crude oil certainly has eased and is now looking a bit more neutral to deflationary than it is inflationary. Gold, what has happened to gold? If ever there was, if you asked me to describe the perfect setup for being in gold, it would be something like this, where we've had lots of uncertainty, we've got increased heightened political risk, we've got everyone thinking we're heading into a time of inflation. Why isn't gold skyrocketing in price? That's what I want to know, and a few million others. But it's just stuck in this range around 1800. Depends what currency you bought it in as to whether it's been doing better or worse in the last 12, 18 months, but very, very surprising. So gold at the moment is not saying we're heading into inflation. If anything, it's kind of, it's being non-committal. It's sitting on the fence, maybe, somewhat deflationary even. So this is why, this stuff is so difficult. I've already said I don't claim to be a guru, but I would have certainly, if I got my little rule book out of what should do what in what situation, I would have said gold should be absolutely thriving now. Now, there is a school of thought that says that money that would otherwise have been piling into gold is now piling into Bitcoin. And some people are referring to Bitcoin as digital gold. Others are saying, well, you can't be serious. It's not physical. I can't touch it. It's got nothing backing it. I know about a gold coin or a gold bar. That gives me great sense of substance and long-term value. You can't ever see gold going to zero. And of course, gold never changes. It's only the amount of fiat currency it takes to buy some gold that changes. So maybe gold is suffering from people moving to Bitcoin. But even so, it hasn't behaved the way I'd have expected it to behave, which I just take as another sign of these very strange, confusing times that we're living in, which make it, I think, harder than ever to be a smart investor in this climate. Lumber very definitely has gone off of its peak. It's crashed and burned over the summer. Again, I think it was an artificial thing from, construction sites closing down due to the banana situation, and then coming back, big time once they were able to get back on site, everyone buying things up to build or extend. And then suddenly, once that initial shock of a demand has been met, it's kind of tailed right back, and it's now gone back to pre-banana levels. Here's one that's interesting, because I think there's conflicting data here between America and the UK. In the UK, we're seeing wages increase in recent quarters. I think it was up 8.8% in the most recent quarter. In America, wages went down. And that's, again, a real surprise and not at all inflationary. So whether this has been some combination of the stimulus schemes ending or being tapered down, whether some people are going back to work, perhaps desperate for work and taking a lower wage than they were on before. It's hard to say. It's probably a bit too early to say yet. But again, surprising data that suggests it's not all the inflationary push that perhaps some commentators would lead us to believe. So that's an interesting one. And there's a consumer sentiment index run by the University of Michigan in America, and that's kind of really crashed in the sort of July, August timeframe as well. It was kind of on a steady upward curve back to some semblance of normality. But then that's crashed. And I wonder if that's also linked to the wage deflation thing, whether they're suddenly realizing that they're actually not as well off as they hoped or thought, because their wages have gone down, they're off the stimulus checks, and perhaps aren't as many jobs around as they thought. I don't know what the detail of that situation is, but sometimes these statistics give you a surprise, and you've got to be prepared to take on both sides of the argument. You can't just be looking for confirmation bias of what you start out believing. So, I would have probably said before I started putting all this together, yeah, we're definitely heading into a period of inflation. And then you start looking at some of these statistics, and some of them support that argument, and some of them definitely don't support that argument. So, you end up thinking, well, what's the answer? What do I believe is true given all of these inputs? I talked about Bitcoin. I genuinely believe that everybody should have some exposure to this new digital asset class. That's why I set up the whole Crypto for Grown-ups program, because I think the failure to invest is based on fear and ignorance. People think it is so new, it is so different to anything we've ever had before. Although, to be fair, a lot of people, certainly at the more sophisticated end of the market, are quite comfortable investing in derivatives, which can get humongously complicated. Contracts for difference and spread betting and things like that are really quite complex. And you really need to invest time and energy and money to get your head around all that if you want to go into those fields. It's no different with the crypto world. You really need to try and learn from people that know more than you do, and have some exposure. I mean, in our mastermind group, I talk about maybe 5, maybe 10% of your net worth. Personally, I've gone for 10%. And some of these things are significant. Bitcoin is up 300% in the last 12 months, even including the 50% drop in May. So to not be a part of that, to have no exposure to that, I do believe is a mistake. And I do see it as a potential inflation hedge, apart from anything else. I haven't got time to go to the whole Bitcoin story here, but Bitcoin and its fellow kind of crypto blue chip Ethereum up 680% in a year. I mean, what other asset class have you ever known that could get you 300, 600% returns in 12 months, even with a big pullback in the middle? So, this is not, I'm certainly not into get rich quick schemes. I know the risks. I appreciate that, it could all crash and burn, but my argument is so could the fiat currency system. No fiat currency in all of history has ever survived. They've all crashed and burned eventually. All empires crash and burn eventually. The dollar will cease to be the reserve currency eventually. The American empire is already in decline. The Chinese empire is not as strong as some would have you believe. It's certainly got its issues with its own debt levels, its own demographics, its aging population, and so on. So China may emerge stronger than America this decade or this century, but you might find there's a surprise coming from somewhere like India or Africa, even. Who knows? But so my feeling is, this is something you should have some exposure to, some knowledge of. Don't bury your head in the sand. The ostrich strategy is rarely a successful one. But my conclusions are, there's no doubt the financial system is broken. All this cash is swirling around in the banks, but the actual velocity of money in the real economy remains low. And there's actually too little demand for loans, because money comes into the economy normally through loans from the high street banks. They create money at the touch of a button, at the click of a mouse. If you want a 500,000 mortgage on a property, they don't go into the vaults and take out all loads of £50 notes. They're creating money in thin air that you then have a commitment to pay for. And so you then owe them so much a month for the next 25 years, but that money didn't exist before. So the total stock of money went up by $500,000 when you took out that loan. Well, there aren't that many loans being taken out at the moment. So the velocity of money is low. How do you encourage people to take out more loans? Answer: you lower interest rates. How much lower can they go? Do they have to go negative until you're paid to take out a loan? Well, that's the dilemma the central banks are facing. Short-term rates cannot fall any further, and yet they need to, if we want to encourage more borrowing, to encourage more velocity of money, to get the real economy going faster. So the only thing that could trigger that would be if the long-term interest rates, the 10, 20, 30-year rates, were to fall even further, which would, of course, be bullish for the bond market. If those rates were to come down, you could still make money from that long, steep decline in interest rates that's caused a long, steep rise in bond prices. So, this cannot be a healthy financial system, clearly. Inflation is obvious and rising in certain parts. The figures in America are far worse than the UK. We've got 1 million job vacancies post-banana because a lot of these people have gone back to the EU or further afield. So you walk down any high street now, every shop, every bar, every restaurant has a help wanted sign. Sales assistant vacancy wanted. Carers, every care home in the country has got carers wanted outside. These are minimum wage jobs where the people that used to do them have gone. So either 1 million Brits have got to get off their backside and do them. Hasn't happened in the past, maybe it'll happen now. Or they've got to find a way of automating those roles, or they've got to find a way of bringing immigration back again, and changing the rules on who can come into the country to do those jobs. Most of the job losses from the banana situation have been recovered, and we are seeing in this country wages going up. I think, I don't know if it's just in America, but, you know, McDonald's is apparently paying people just to turn up at an interview now. They're having to incentivize people to actually get off their bum, get off their stimulus checks and their further, and actually come looking for a job. So that doesn't augur too well, does it, in terms of the level of commitment? The workforce participation rate, as it's nicely called, is falling. Fewer people can be asked. That is the bottom line. So again, this doesn't make me feel confident about the future of our economy. And as I say, many low-paid people have already left anyway. So who's going to do this bottom-end work that's kind of minimum wage? Does it mean you just have to keep hiking the wage until people are incentivized to come and do it? How far do the wages have to go to do that? What would be the impact of that level of wage inflation on the real economy? These are things we shan't know for probably another 6 to 12 months, but you know, these are the kind of machinations that are going on at the moment. So what do we do? Well, raising interest rates, which would kind of normalize them, you know, that would be the technically correct thing to do, but of course that would bankrupt everyone. Governments, companies who are issuing junk bonds at very low rates of interest, household debt, none of it would be sustainable. It's what, 7 or 8 years now since the Federal Reserve tried doing this, and the markets just crashed and burned. So they know that they can't raise interest rates. In fact, if anything, as I've already said, they need to lower them further to try and stimulate more lending and stimulate the real economy. Even just tapering QE, which the recent Jackson Hole meeting, Jerome said, yeah, I'm going to start thinking about tapering maybe in 22, 23. Clearly, they are starting to see they're going to have to do something. They have to send signals to the market. Even that has caused a little bit of a wobble, but nothing like the taper tantrum we had a few years ago. But you know, we are seeing, I think the Bank of England has stopped the last 40 billion or so of its QE program. No signs of that in Europe yet. There's still a big stimulus program going on across the EU. So yeah, higher interest rates would cause property prices to crash. That would be one of the many things that would happen. They are, you know, it's nothing magical about why property prices keep going up. It's just down to credit availability and low rates of interest. I mean, yes, there's been government stimulus programs that have helped that along, but most of it is quite simply due to the fact that credit has never been cheaper or more easily available. And there are more and more low-cost mortgages coming into the market now. So it's getting worse. Yeah, it's a stalemate. Basically, the central banks and the governments have painted themselves into a corner where they can't stop QE all of a sudden. They can't raise interest rates. So what ammunition have they got left? I mean, and now they're starting to talk about having responsibility for climate change and ESG and all this sort of stuff. Well, hey, guys, you ain't got time to worry about that. You've got to try and sort out the real economy here. What you're going to do about it? You know, and we have to try and sort out our investment portfolios and make our decisions based on our best guess as to what these jokers are going to do. Ultimately, you have to assume that all of this leads to inflation, to loss of purchasing power. We're seeing asset bubbles left, right, and center. Obviously, the more you inflate asset prices, whilst you don't inflate wages, you're just creating wider and wider wealth inequality. There'll be a lot of social unrest. Now, one of the victims of banana land has been media freedoms. It's not just in Hong Kong that the media is being restricted. I have to go onto Twitter to find out that there's been enormous protests in France against banana passports, and in Amsterdam against, you know, banana medicine. You know, these things are not even reported on the BBC, which has become a kind of a propaganda mouthpiece for the government. So, you know, again, where you get your information from, who and what you trust, you know, you've got to be a little bit careful. You know, I'm not a tinfoil hat kind of conspiracy theorist, but, you know, certainly there is a restriction in things that are being covered in the media, and you've got to look a bit further afield to try and get a better, accurate overview of what's really going on in the world and where it's all going to lead. So as we come into land, what can we be certain about? I think the one thing that this all points to for me is the continuation of an unstated policy of the last 13 years, which is financial repression. Interest rates are going to be kept deliberately below the rate of inflation in order to slowly inflate away government debt. That's the only way they can do it. They're not going to default, and they're certainly not going to grow their way out of this. So the only thing that can happen is ongoing financial repression. So you have to be aware that you are going to be robbed. You're going to have your wealth stolen every day, every week, every month, every year, forever. That's the plan, I would say, for at least the next 10 or 20 years. These debts are too big to go away in a year or two. There will be increased taxes, partly to contribute to this, partly to be seen politically to be doing something against the evil rich. That's you and me, by the way. And then partly, to placate the masses. But the main thing is for those who already have wealth, things like cash in the bank will be losing its value probably at the rate of 6, 7, 8% real terms every year. It doesn't take many years of that for you to lose half your wealth. So be very careful how you deploy your funds. Savers are robbed in financial repression. Interest rates being this low, simply mean you're being robbed every day. It forces you to go into things like the stock market to try and get a better result, and perhaps the crypto market. The sort of investments that Beaufort Society do, they're all geared at getting a better return or a better capital gain from a growing, fast-growing business than you can get in things like savings accounts. Cash in the bank is a joke. Most bonds are a joke. Even corporate bonds, where you're taking quite a degree of risk, you might only be getting 3 or 4% return for a substantial amount of risk. So, exactly what you invest in becomes more important than ever during financial repression. There's even an argument that says, now I've seen some people, I even saw Robert Kiyosaki talking about this the other day. He was borrowing money at a very low interest rate on a long-term fix and then investing it. So, we can't give investment advice on this program, but somebody that borrowed £100,000 at 2% and put it into a cryptocurrency that was returning 300%, I speak deliberately of the extremes to exaggerate to make a point, but you can see why that might become attractive. Now, investing on leverage is a very high risk game, and a lot of people, certainly in the crypto world, that lost money were the ones that were investing on leverage. So this has to be very carefully managed within an overall asset allocation strategy. But even smart people like Robert Kiyosaki are doing this as part of their portfolio. So there, in summary, we've got some trends that are clearly pointing towards significant inflation, some things that are pointing towards deflation, notably the bond market and I think commodities at the moment. The only thing I would say with certainty is that interest rates are well below real inflation and will stay well below real inflation. So financial repression is going to be the overarching phenomenon that we have to deal with in the 2020s. Now, if you'd like to go a bit deeper on this sort of thing and how to try and survive and thrive in what I do believe is the weirdest and strangest decade of my lifetime, certainly, and I think of many people's, I have created a program that will potentially be of interest to you. There's a free webinar to watch. If you go to renegadeinvestoracademy.com/playback webinar. Sorry, it's such a long domain name, but that's what it is. renegadeinvestoracademy.com/playback webinar. Watch that webinar and see if that program might be of interest for you. That's pretty much all that I've got to share with you today. So I will say thank you very much for watching, and I will see you next time.